Consulting. We're so happy you could join us today. I'm Diane Probert, and I'll be your moderator, and I'll be monitoring any questions you may have during the session. Before we open up today's session, let's just review a couple of key items. First of all of the webinar materials we discussed today can be found on this website, the Heffernan webinar website, in addition to all of the upcoming webinars. So if you just scroll down this page, you can see all of the webinars that we've had in the past and all of the webinars that are coming up in the future. If you'd like to join any of them, just go ahead and click on the link. And then if you slide all the way down to the bottom of the page, the webinar materials resources are here. And if you go all the way down, you'll see today's webinar, The Risk Cycles of High Growth Company. Go ahead and click on that link, and you will be able to get a PDF presentation, a copy of today's presentation. If you have any trouble with your internet connection during our webinar today, we recommend that you leave the presentation and then log back in. And if you have any audio difficulties or your telephone line goes dead, just go ahead and hang up and call back again to the same number. If all the lines go dead, watch the on-screen chat box for an alternative call-in number. Feel free to ask questions or provide feedback via the chat box during today's webinar. If you're using a tablet, you may need to tap on the screen for the options bar to appear. Then you can select the appropriate option. We'd like to encourage you to ask any questions that you have during the presentation. And if we can't get to your question during the presentation, we will be online afterwards to respond. However, we will have a Q&A session at the end. This will be a 30-minute presentation. And today's interactive session will be facilitated by Joe Talmadge. Joe leads the technology practice at Heffernan Insurance Brokers. He's been specializing in high-growth VC and PE funding companies for the past 15 years. He continues his expertise with late-stage startups and private-to-public transitions, with a focus on executive risk, professional liability, and alternative risk products. Joe has a bachelor's degree in information technology from the Syracuse University School of Information Science, and he also holds a bachelor's degree in marketing from the Syracuse University School of Management. Joe served on the board of Insurance Brokers and Agents of the West, Silicon Valley, as the legislative and publication chair. I'm going to go ahead and turn over the screen to our presenter. Thank you so much for being with us today, Joe. We look forward to your presentation. And Joe, if you just want to, to click to show your screen, and there you go. You can just go ahead and start your presentation. Thank you so much.
Thank you, Diane. Sorry about the technical difficulties there. And thank you, everyone, for joining today. In addition to my background, I kind of wanted to go over the Heffernan practices as well. And the reason why it's relevant is because there's been a huge infiltration of technology into several of the different practices at Heffernan. Some of our other specialties include nonprofits, healthcare, real estate, construction, hospitality, transportation. One of the practices that we're going to be talking about in particular is technology today, and one of the key changes that we've seen develop over the past, I would say, 3 to 5 years is the emergence of something called the sharing economy, the on-demand economy. And so part of the reason why we put this presentation together is because some of our other practices have requested to understand a little bit more about what the considerations are for the life cycle of a startup in the insurance purchasing process and the risk management process, who owns it and such. So when you think about technology in transportation, you have companies like Uber and Lyft, Instacart, Postmates. If you think about hospitality and technology, you have companies like Airbnb, HomeAway, WeWork, Pivot Desk. If you think about household services and technology, there's companies like TaskRabbit, Neighborly, and even in the finance sector where we have companies like Prosper and Lending Club that are converging several of the Heffernan niche practices and our technology practice. Within our technology practice, we have some traditional technology capabilities in life sciences and medical technologies. We also have hardware and device manufacturing companies. We have a significant presence in semiconductor manufacturing. And we also have a very strong presence in the software side, including social media, business-to-business SaaS companies, and e-commerce companies. But again, one of the reasons why we put this presentation together is to really highlight the uniqueness of a high-growth company and the different insurance considerations through that process. My hope by the end of the presentation is that if you are an early stage company, in addition to the key coverage considerations, you'll understand the philosophy behind why you might consider them. You'll also gain some insight into how to coordinate the ownership of the risk management function and the insurance as the company grows. If you are a late stage or mature company, I hope that you can identify what your team has already done and compare it to what we see as best practices. And if not, maybe retrace steps and reassess what the plan might be going forward. And as a last sort of goal, hopefully you'll find something in this presentation that's interesting and maybe like more information on. There's some things that we're going to be covering today. This is a very brief presentation, so if you would like additional information, definitely hold your questions till the end. We can address them, or if you'd like to follow up with us afterwards, you can do that as well. So I'd like to start off with some polling questions just to get an idea of who is on the line.
Okay, so I'm going to go ahead and launch that for you, Joe. And everyone in attendance, if you could just click on the screen and answer what is your role and which best describes your role in your office. Are you the founder, CEO, CFO, finance, HR, legal, or an investor? And if you just go ahead and click on the one that best describes your position, we really appreciate getting your feedback. It kind of helps Joe be able to know who his audience is, and we appreciate you answering the question. I'm going to go ahead and close out that poll. Thank you so much for participating. Much appreciated. And Joe, it looks like 9% are founder, CEO, 27% are CFO, finance, and the largest portion of our audience today at 64% are HR representatives, no legal, and no investors.
Okay, great. Are we back on my presentation, Diane?
Yes, we are.
Okay. So thank you for answering the poll. I'm starting off with the entire life cycle of what we consider a high-growth startup. And again, this is across all industry sectors, and as I had mentioned before, there's been a convergence of technology in several other industry sectors. But many of you, if you've been involved in a high-growth company, have seen a timeline similar to this. What we've done is superimposed some of the key players involved in the insurance purchasing process on the top, and we'll talk about each one of these stages. The early stage on the left, this sort of scaling stage in the middle, and then your profitability or exit stage on the right, and what are the considerations that should be made. But one of the things I want to point out in this timeline is that you can see that on the top, the ownership of risk management really does change as you go through the life cycle of the company, and the question really should continually be asked: who is owning insurance and risk management? And the answer to that question definitely changes as you progress through the different stages of the company. So we'll start off with the seed and early stage cycles of a company, and you can kind of see that there's not a whole lot of people involved. You typically have a founder, and a lot of our initial phone calls for insurance are from the founder, and that person is really focused on getting their company up and running and maybe getting their products proof of concept. They might even be in the R&D phase. And so when we initially talk about the insurance purchases for a seed or early stage company, we're really thinking about it from a compliance standpoint. And what we mean when we say that is there's going to be certain things that the company just needs to have if you're going to be operating. So if you want to move into a lease, or even if you're doing a shared office space, they're more than likely going to have some really, really basic insurance requirements for your company. So the items that you see on the left-hand side of the blue box, general liability, auto liability, property, workers' comp, key person, these are all pretty standard insurance purchases for a seed and early stage company. When you have a startup and you don't have employees, the workers' comp can probably wait until you do have employees. And another really key point on here I wanted to talk about was the property R&D. Sometimes we get companies who have milestones that they need to meet in order to get their next round of funding. And so one of the things we'll talk about when we talk about the property risk is business interruption insurance and whether or not the client would like their property insurance to pay out if they don't meet that milestone. And there are very specific startup geared products that will pay out even if you have zero revenue. They will give you a milestone payment if you have a fire and you're unable to complete whatever you were supposed to complete by that next milestone to get that next round of funding. So those products are out there. They're really, really geared for early stage and seed funded companies. On the right, we have some other items like directors and officers insurance, employment practices liability, also known as EPL, errors and omissions, which is inclusive of a whole slew of products ranging from technology E&O to traditional E&O to malpractice to cyber privacy and data breach. All of these line items, and we'll talk a little bit about that later in the presentation, all of these line items fall under the E&O realm. And then you'll see they have a little line item for self-insurance, because the reality is you don't really want your company to go out of business before you even start purchasing insurance. And while Heffernan Insurance can sell you every insurance under the sun, if you're this early in your startup, there's really just some basic things that you should be focusing on. And the items on the left are typically what we see as some basic initial insurance purchases. Now, that being said, the line item for D&O we do see on some early stage companies, and the thought process behind this is really based on the demographic of the founder and the executive. And when I say that, what I mean is the risk tolerance for a 20-something founder of a startup that maybe doesn't have a whole lot of assets and is kind of running a million miles an hour is very different than the risk tolerance for a seasoned executive who maybe has gone through a few startups, has cashed out, has a fair amount of personal assets at stake, and their thought process behind why they might want to insure for their management risk is very, very, very different. So there is no one answer on that particular line item. It's going to depend on the risk tolerance of the founder and the executive himself or herself. And that's a really key thing to note for directors and officers in particular. As far as the errors and omissions line item, we get a lot of questions about, do I need errors and omissions insurance, especially in the tech space. One of the things I'll say is that on the left-hand side, you see these general liability, auto liability products. A lot of these products will actually throw in some degree of E&O, and so the breadth of coverage that you would get on a standalone E&O policy is maybe something that can wait till later. And a lot of what you might want to just have in place at this stage of the company could probably be fulfilled in a single policy for most of these line items. So oftentimes what we'll see is companies purchasing these all in a sort of package. So we're going to spend a lot of time on the next slide, which is the scaling and late stage part of a high growth company. And as you can see, the function of the founder, and maybe even at some of the early stages you bring on a CFO or a key HR person, that person's function will spread into several different functions of the company as you start to get into your either a large B round or C or D. And the people that come on board to take over the risk management function and help out with the risk management function are the people that we have shown in this this particular part of the slide. So you have VP of Finance or somebody of that of an equivalent, another VP of HR, maybe an entire HR team is being brought on board, a controller, global controller, in-house legal, and the legal team starts to get a little bit more mature. And so what used to be a single person or maybe even a two-person function spans out into a several-person function. And so again, we refer back to that question, who is owning the insurance purchasing and risk management? And so I'd like to highlight myth number 1, is what I like to call it. And that myth is that there is one contact for each line of coverage and associated risk. And that is just simply not true. The truth is that it is actually a team effort across all of the internal functions in a company. And a great example of that is, well, I have 2 examples actually. One is just basic general liability. If typically general liability is picked up by someone on the operations team, maybe a controller or a director of operations at this stage, and their purchasing decision on the general liability will impact what the sales team is doing. And a great example of that is the phone call we get on Monday morning because the salesperson needed a certificate on Friday and the certificate didn't have the right additional insured wording, didn't have the right waivers of subrogation, and so their deal was held up because the insurance just couldn't get placed. And those situations typically happen because whoever is managing the insurance isn't really talking to sales or operations to see what do we have coming through the door from a contract compliance and what are the typical standards that we are seeing come through and how does our insurance meet up with those standards. And it can be a huge deal if you have the proper insurance program in place to help your sales team sell. And people oftentimes don't think about that, but it really does come up quite a bit, and it's a regular phone call that we get in our office. Another one where you will see very regularly, and the HR people on the line will care a lot about this, is the employment practices liability side and its interplay with workers' compensation. And particularly with the rise in the on-demand and sharing economy especially, there's been some really key coverage overlaps between workers' comp and employment practices. And just for people on the line that don't know what employment practices is, this is the coverage that responds in the event of a discrimination lawsuit, a wage and hour lawsuit, although that coverage is very, very limited as far as what you can get in the marketplace. So discrimination, sexual harassment, disparate treatment claims, and typically the workers' comp is handled by, you know, a person on the HR team, and the EPL can also be handled by someone on the HR team, but sometimes it's also handled by legal. The reason, regardless if it's handled by individuals on the HR team or HR and legal, the coordination of a workers' comp claim that has an outstanding EPL claim as well is really, really critical. And the reason is because the closure of workers' comp claims have a certain direction that they head if you rely just on the claims consultant's direction. And typically if you're working with a broker, they'll probably have a workers' comp claims consultant assisting you through the workers' comp claims process. That strategy may be very different if you have an outstanding employment practices claim. And there's probably assigned counsel from the workers' comp carrier that is directing the workers' comp claim in a certain way, and there's probably assigned counsel on the employment practices side that is directing the employment practices allegations. And those directions may be different, and the coordination of those is really, really critical, particularly if you have a high profile or a really complicated case. And so my recommendation, particularly on the labor issues as the company is scaling, is really to keep an open line of communication between all functions that touch the labor risk. Which brings me to my next myth number 2, and that myth is that having insurance is simply enough, and that is not true. The reality is that having insurance is just the beginning of managing your risk, and if the company and the individuals and the stakeholders for the risk management of the company are not managing the risk appropriately, the insurance will ultimately be cost prohibitive. And when I say cost prohibitive, I mean cost prohibitive to the point where the company may be out of business or may not get their next round of funding because of a poor risk management. And so it is really, really critical that beyond just considering their insurance purchases, the team considers how they're actually managing risk within each of those. So I have some things noted in the bottom left-hand side of the orange box, and one of them is insurance program efficiency. When we talk about the program efficiency, we're talking about things like renewal date consolidation. So at the very early stages of the company, insurance was probably bought on a as-needed basis, like I said, from a very compliance standpoint, and there may be multiple renewal dates all over the place. And so one of the things that we'll do when we get into a company at this stage is try to consolidate the major renewal dates that are relative to each of the major risks into one sort of portion of the year, depending on when the stakeholders want that to be. So things like labor risk, again, we can talk about the EPL and workers' comp. Things like operational risks, that would be your general liability, your property insurance, your auto liability, and then your management liability and your professional risk you may want to have on a single dedicated renewal date. And part of the reason why we do this is to coordinate efforts so that your team, your finance, HR, your legal team is not stressed all throughout the year dealing with random insurance renewal dates. They have a expected time on when they're going to be dealing with these things. And if anyone has actually dealt with an insurance renewal process, they know it's not the most pleasant experience. And so you're going to have to be filling out applications, maybe multiple applications. There may be some loss control considerations that need to be made that will dedicate labor and time from your team to. And so if you tackle each one of these major functions at different times of the year, it starts to ease the burden a little bit. But most people don't really think about that as far as the indirect labor costs and the time costs that it takes to manage each one of these major risk functions. And so I would encourage you and your team to maybe think about, okay, who's owning the purchasing part of the insurance process at least, and how do we want to, or where do we want that in the year? The second item on here is premium audit reviews. When we have a company that's scaling, one of the things that they get hit with are audits, premium audits. And oftentimes these audits are astronomical, they're shocking, they are the reason why people leave their broker. They are usually a result of no effort put into whether or not the audit makes sense. And I'll give you two examples from the past 6 weeks of a client that we had in the early stage that was just transitioning into the start of their late stage, and they received a GL audit for $50,000 on a $10,000 premium. And long story short, we went and questioned the audit and inquired as to whether or not it made sense. And we ended up having the audit waived. Now, why would an insurance company do that? Because if you present the right case, they will make accommodations. And one of the key things I would just write down is that more risk equals lower rates. So when you're early stage, you don't have a lot of risk, so you generally have very high rates assessed to your insurance program. And this is applicable, typically for general liabilities and properties insurance and professional liabilities. So if you consider the fact that you're scaling very rapidly and you have a high rate and you all of a sudden have a high exposure, high risk for whatever they're underwriting on, you are going to end up with a very large audit. Case example number 2 was on an auto liability program that just renewed 4 weeks ago. and we had an audit for the 14 to 15 program on that. It was an $850,000 audit. We took a look at the audit and said, hey, you know what we projected was actually way lower than what was actually done, and we ended up negotiating that audit down to $200,000. So still a good chunk, but $200,000 and $850,000, a pretty significant difference, and we had no real obligation to question the audit other than the fact that we just knew that it was not rated appropriately. So if you're not working with somebody like me or an experienced Heffernan professional, what can you do to sort of give your broker the tools to make those negotiations? I would say the number one thing that you can do is to look at what your renewal rates are for the projected exposure, your projected risk. So typically these policies are rated on a sales or payroll, or those are the two primary rating bases. And look at what those rates are, and then maybe back into what your expiring policy was and try to come to a compromise with the auditors and the underwriters as to what is a reasonable rate. And typically you will gain some ground, especially if you're scaling very rapidly. So another thing to consider at this stage in the company is loss control engagement. And what we see a lot of times is the team is growing so rapidly they have zero time dedicated to loss control, and it's really important to start engaging in safety protocols, and if you're a tech company, maybe some considerations on your data ecosystem for your cyber privacy and data breach risk. For all companies, I would definitely look at how your cap table management is looking. And the reason I say that is because we'll be in the middle of a D&O renewal and the underwriter will ask for the cap table, and it just doesn't make sense, or there's a lot of unanswered questions, and so we will typically, you know, recognize that and refer our clients to a very strategic accounting partner that we have that can help with cap table management. Things like options communications and whether or not that's being done properly. A lot of our startups are giving stock options to their employees, and how is that being communicated and what does that look like? And so that can impact what your EPL risk is and what your D&O risk is, and so we generally recommend that you are working with somebody to get those loss control engagements going. This is also a great time to review the entire program and go through a formal risk management assessment, which can be, you know, very high level, or it can be detailed. And when I say detailed, I mean interviews with each of the key stakeholders that you see above to discuss where they feel the highest risk in the company is. And typically what will come as a result of the risk management assessment is some pretty key insights into where the company has insurance and where they don't have insurance, and whether or not it's a risk that wants to be addressed. And oftentimes we will interpret that in the form of a presentation, usually to legal, but that legal presentation oftentimes incorporates compliance, HR, finance, and just because it's really important from our standpoint that everyone is on the same page with regards to what is in place, what's not in place, and what are the priorities going forward. So this is a great time to engage in that process. It's also a great time to look at some of the benchmarking, not for where the company is at today, but where the company is likely to be tomorrow, because if the company is not carrying appropriate standards for where they want to be tomorrow, it will definitely hold up what the sales team is trying to do to drive growth. So, last item, the specialty lines like cyber liability, product recall, international risk. This is also a great time to consider these line items. Many companies want to use their capital for growth at this stage, but it's also a key time to consider whether or not you have a material risk in any of these specialty areas. Another one is pollution, if you actually have product out there. So doing some benchmarking and some review of specialty line items is really critical at this stage as well, and it'll set you up, even if you buy a small limit, for sort of a good credit mentality for future limit increases as the company grows. And I'll give you a good example of that. If you are buying cyber for the first time today, the cost to get a $15 million limit is going to be significantly more than if you already had a $1 million or $2 million limit in place and you're just building it going forward. So the underwriters definitely give you a positive outlook if you've already had coverage, even if it's at a lower limit. And so going through that process early on, even though it might be a little bit preliminary during this phase, is really important if you think that it's something that is going to apply down the road. We don't really talk a whole lot about formal self-insurance mechanisms at the scaling stage, and that is typically because the companies that we are working with are using their capital for growth, oftentimes operating at unprofitable levels specifically for that reason. And so engaging in a formal self-insurance strategy is really not seen at this time. So if you are coordinating risk appropriately and the company is continuing to be successful, you will probably get to what we see as sort of the final stage before you taper off into a grown-up, mature company and or exit by selling off to somebody, going public. We have seen a couple reverse merges in the past year. But typically this is going to be when you start thinking about risk in a different way, and hopefully by this time you have already, or your team has already, coordinated enough risk management and put enough protocols in place so that when you have these new strategic staff members who are going to own risk management and be part of the ownership of risk management, like your CFO that has your IPO experience, or your treasury executive, or your dedicated risk manager, these people are going to come into your organization and assess, has this company been doing the things that they need to do, and what is the size of my job once I get on board? And if you have good protocols in place and good risk management in place, it's actually pretty attractive to an experienced executive to walk into that scenario. So it does pay off even in talent retention or talent acquisition. And so I would recommend getting these things in line before these people come on board. I have a line item on here for executive retention and D&O. That is something that if you are looking for some high-end directors and officers, high-end HR folks, high-end finance, high-end anybody really, they are going to want to know that there is some executive protection for what they're doing for your company. And they will look at the D&O policy, and they will want to know that the appropriate coverage form is in place. And one of the things that, if you're going from private to public, that is important is to make sure that you have roadshow coverage if you're doing additional financing, and do a full benchmarking analysis for what the company is going to look like going through that IPO. So another item that we have on here is self-insurance and alternative risk analysis. And when we talk about self-insurance and alternative risk at this stage in the company, we're not talking about it in the same context that we were when it was a seed and Series A company. At the seed and Series A size, self-insurance meant I'm just not going to buy insurance. But you're not actually dedicating any capital, you're not dedicating resources to self-insurance in that stage. At this stage, you are. You've decided that, you know what, we have pretty good risk management protocols in place, and we can start to assess how much risk we would like to take on as a group instead of purchasing it in the insurance market. And so if you're working with the right professionals, you will be able to assess across which line items you can start to consider self-insurance, and that may come in the form of things like quota share programs for property insurance, high deductible programs for GL, auto, or even workers' comp. There's retrospective programs for workers' comp. There's also captive programs which can span across all of those. And within each one of these alternative risk mechanisms, there's different considerations to make, but if you're performing well from a loss standpoint and managing risk well, there is highly likely an immediate and significant savings to be made, but there's going to be different tax implications for each. And so at this stage, you probably are bringing on, if not already have on board, a tax expert and some resources internally to determine which one of these alternative risk resources is going to be the best for you. And for that particular line item, some line items have much larger, what we would call legacy liabilities than some others. For the HR folks on the line, this is also a time when the self-insurance or partial self-insurance of the health insurance plan might be something that may be considered. And there's a lot of value to looking at that as far as looking at utilization review and getting some insight into the transparency of how the benefits plan is being utilized. So, and Heffernan has an entire benefits team. I'm sort of the risk management side on that particular topic. Also at this stage, you're going to see different mergers and acquisitions insurance strategies. So there's mechanisms that are available for transferring risk in an acquisition for things like a breach in reps and warranties. You can transfer that risk, maybe lower the escrow amount that is being posted for an acquisition. There's things like a litigation buyout insurance policy, which can transfer the risk of outstanding litigation. It's kind of like buying insurance after there's an issue. There's also tax liability strategies that you can employ for undetermined tax consequences that will be determined after the transaction occurs. So to speed up the transaction, you can look at these policies. And so there's a myriad of M&A insurance strategies that should be taken into consideration. And then there's also obviously the executive tail risk coordination that should be discussed as well. So that kind of leaves us at the final stages of a high growth company. After this stage, you will probably go into a more formal enterprise risk management where you're looking at more than just what we would call hazard risk, liability, and property torts. You would start looking at, pricing risk, asset risk, currency risk, operational risk, and strategic risk with competition and social trends and such. So, but that's a little bit later on after you've gotten through all the high growth trends of the company. So with that, I'll leave the rest of the time for Q&A. I kind of ran through a lot of that, and if there are questions, now is the time to ask.
Okay, Joe, we do have a couple of questions already, and then I would encourage anyone in the audience, if you do want to ask additional questions, go ahead and just type them into your question box, and I will relay them to Joe. So our first question is, would a claim from an employee for health issues arising from harassment at work fall under the employment practices or the workers' comp?
Almost 100% employment practices. That's without knowing too much about the claim. But if you are terminating somebody for having health issues, depending on what those issues are and depending on what their allegations are, if they're claiming that you discriminated against them, then that would very clearly be employment practices. If the health issues were a result of occupational injury and that was the allegation, then it's possible that there may be some workers' comp claim triggers there as well. But without knowing the details of the case, it's a little bit difficult. But essentially the rule of thumb on that is if they're claiming occupational injury, then it's going to be a workers' comp claim. If they're claiming something like discrimination, disparate treatment, unfair treatment, then that's likely going to be an employment practices claim. And again, to sort of repeat what I was talking about before on the EPL and workers' comp issues, it's very, very, very often that we will see a convergence of both on a single claim, especially if that individual has a good applicant attorney representing them, and we do see that quite often. That applicant attorney will take that case as far as they can and try to get as much out of the claim as possible. And one of the things they can do, one of the strategies they can employ, is to bring on an employment practices lawsuit, because what that does is it kind of lengthens the time that that claim is going to be open, and consequently it costs you a lot more money as an employer and a lot more time and labor resources to manage that claim, because you're not only dealing with workers' comp, but you also have employment practices to deal with as well. But again, all of this is based on the allegations that are being made.
Thank you very much. We have another question. Who does the loss control, us or the insurance company?
That's a great question. The insurance company will give you resources, and your broker, whoever you're working with, should also be giving you some resources. In addition to just hard resources, the broker can also assist with coordinating the loss control resources that are available at the insurance company, and so all of these resources are essentially given to you. Some of them cost a small amount of money, but for the most part, there's a significant amount of loss control resources that are available to all clients, and they're severely underutilized, and part of it is because it's incumbent upon the client to want to incorporate them. So if a broker and an insurance company come to a client, I have one just last week where the senior loss control rep, scheduled a meeting and showed up to the client's office. The client confirmed, and they came out and nobody was available because they were dealing with, getting their new location set up, and that was more important than managing the risk. So, if you're growing rapidly, loss control probably isn't at the top of your list, but it definitely will pay dividends if you invest a little bit of time to invest some time and labor resources internally at your company to incorporate what is already available to you through the insurance carrier and through the brokerage. So it oftentimes does not cost you money, and if it does, it's a very small amount of money for what you're going to be getting on the back end. So it's kind of twofold, available through the broker and insurance carrier, and then delivered by the client. If the client doesn't take ownership of those resources, then it's kind of like having a Ferrari and leaving it in the garage.
Okay, thank you so much. We have one final question, and that is, what should our number one focus be on to lower our insurance rates?
I would have a question back to that individual to inquire on where they are at in the high growth phase. Are they a seed or Series A company? Are they a company that's scaling rapidly and maybe in some late stage fundings, or are they already mature, exiting, or maybe just a mature company and trying to look for ways to reduce risk? And I think the answer is different for each stage. And so unless they tell me, it's a little bit difficult, but I'll go through each one of the stages. At the seed and Series A stage, the number one thing you just want to do is negotiate as low premiums as possible. And typically you're going to get minimum premiums anyhow, especially at those early stages. As you scale, I would say the number one thing to look at is getting your policies on what's called a flat basis, because if you're scaling, it's really valuable to not have an additional premium audit so that you can use your capital for growth. You don't want to end up in a situation like my other company where they had an $850,000 audit and we're sitting here trying to negotiate $650,000 off of it. So if you can get flat rates, sometimes it's not possible, especially if they know that you're scaling, but if you can get flat rates, definitely do that. And then number two for the scaling company is, if you are on an auditable policy, try to spend some time looking at your audits and inquiring as to whether or not they make sense with what you're getting for your renewal rates, and back in and negotiate those audits. That will really save you a lot of money. If we're talking about a late stage company or a mature company and you have the capital to start engaging in formal self-insurance mechanisms, then I would say start looking at those self-insurance mechanisms, because I have yet to look at a client where it didn't immediately save them a lot of money, and multiple years down the line save them even more money. And the sooner you start looking at them, it's the better, because you don't need to actually do anything immediately, but having the knowledge of what's available to self-insure, or if you're in a position to self-insure, is really, really valuable to going back to the board and saying, hey, this is what we're seeing as a potential savings in our insurance, and here is the associated risk with it. And it's not as scary as you think it is when you actually see the actuarial layouts, because you will get a high end of maximum risk and you will get a low end of savings to kind of demonstrate that against, and you'll get an expected loss scenario where you'll have a pretty good idea based on your actual performance of what the total cost of the program will be. But almost unequivocally, if you remove the insurance carrier's profit line item, then that's going to give you an immediate savings. And a lot of these alternative risk strategies, that's exactly what they do. They end up putting that line item back into the client's pocket. So if you haven't engaged in that and you are a mature company, I would say do that immediately, at least see what it looks like.
All right, well, thank you very much. This is going to conclude our webinar for today. I want to thank everyone for being with us. And as a reminder, our resources for the Heffernan website will be up and ready for you to get a PDF copy of today's presentation. I will also be sending you all an email thanking you for attending, and that email will have a link as well to the resources. Thank you again for being with us, and thank you, Joe, for your presentation, and everyone have a wonderful day.
Thank you, everyone.